Money talks, BS walks, strong balance sheets, and very strong liquidity positions. It does do a lot at the end of the day from a credit risk standpoint, but the banks that we're talking to, character is important.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Had a great conversation in this episode with Pat Brady of Brady Capital Advisors. Pat is one of the most well-known mortgage brokers and debt brokers in the New England commercial real estate market. Somebody that I've gotten to know very well over the last few years and who I've worked with on a handful of deals in the last few years as well, whether he's sourcing debt for us on the buy side when we're taking a deal down or helping us refinance our value add projects into longer term stabilized debt that we've actually executed a business plan on. And Pat and his team do an incredibly high volume of originations and source a number of loans for multifamily investors throughout all of New England. Their firm's based in Massachusetts. Pat is from Massachusetts, but they work with investors in Maine and New Hampshire, Massachusetts, Rhode Island, Connecticut. And him and his team just have an incredibly extensive network of local banks and credit unions that they maintain great relationships with. And they bring those relationships to their clients on the actual brokerage side in terms of sourcing great debt. The best debt that I think we found in our business for the deals we've done has been sourced by Pat and his team. So really excited to have him on the podcast to have a conversation where we touch on multiple different topics. A lot of evergreen topics such as how to be a great borrower, how to find a great mortgage broker, if you're going out there and actually trying to build a relationship with one. We spend a lot of time talking about how the actual lending market and debt market has changed over the last 12 months, 24 months. And we spend a lot of time talking about what it looks like today. We recorded this conversation on April 30th of 2024, and it's going to be going up pretty quickly. I believe this will go up on May 7th. So a lot of what we talk about in this episode is extremely applicable from a current events standpoint. And if you're a New England investor, I certainly recommend you listen to this because it's going to be an incredibly tactical and value add conversation that you're going to pull a lot of info from. But even if you're out of market and you're operating elsewhere, a lot of what we talk about applies to banks that are lending throughout the country. And we also touch on how New England is a very interesting market from a debt standpoint because of just the very high density of local and regional banks and credit unions that are at investors' disposals, how that relates to the lack of distress in New England in the multifamily sector. And this is just a wide-ranging conversation where we spend a lot of time talking about more evergreen topics as well as current events topics. And I think every listener is going to take something away from this. But if you're from New England or you live in New England and you're investing in New England, you are really going to take something away from this. So stick around, give this episode a listen. And if you haven't already, please consider leaving the podcast a rating and review. And if you're a New England investor who's looking for a great debt broker, a great firm to work with on the debt side, definitely consider reaching out to Pat. I give him an A+ review in all of my experience working with him. So I highly recommend you reach out to him and build a relationship with him and his team. But again, leave the podcast a rating and review if you've ever learned something from these episodes, as it helps the show get in front of more folks. But without further ado, let's get to my conversation with Pat Brady. What's going on, everybody? Welcome back to the Multifamily Wealth Podcast. Joining me this week is Mr. Pat Brady of Brady Capital Advisors. And as you just heard, I probably gave a lengthy 2-3 minute intro on him, somebody that I've worked with for a long time, somebody who is extremely plugged in to the New England real estate markets, and then the debt market in general, as it relates to whether it's New England or nationwide. I think we're going to talk about a lot of different topics as it relates to securing financing in the capital markets that is relevant to everybody listening, whether you're operating in New England or Mass or New Hampshire or outside of that area as well. So Pat, excited to have you on, excited to have this conversation. Why don't we start with your backstory in your own words in terms of how you got into the real estate business and what you're up to today?
Sure. I guess I'll try and give you the short version. I was fortunate enough to have an internship in high school with a CPA, and she had sold her tax practice after I graduated high school and took a CFO job at a real estate development company. based in Massachusetts, and fortunate enough to get me an interview for an internship at this real estate development company, and the rest is kind of history. Just had some really good mentors along the way. Got to understand acquisition underwriting and work with some really smart people. And was fortunate enough to move over to the lending side of the table after seeing how the equity folks kind of underwrite deals, and see where value can be found. And I went to work for Arbor Commercial Mortgage, which was a national Fannie, Freddie, FHA lender. Did almost 6 years there, and kind of saw how the sausage got made on that side. And it was I was a production analyst to start in their screening department, as they called it, and moved over to underwriting. Had some success, and thought I'd try my hand at originations. And I thought all the sales guys just forwarded me emails for a living, and it was a rude awakening to understand what really goes into relationship development, and being a resource for people, and establishing credibility, and showing folks that you know how to execute. So while I was doing originations at Arbor, I had called on another boutique commercial mortgage brokerage outfit in Mass, and tried to pitch them some agency product, and they ended up pitching me on a job. So I moved over to the dark side, as they say, and went into commercial mortgage brokerage. And I was with that firm for almost another 6 years, and I had some life events happen. Got married. My wife and I had our first child, and I always kind of had that entrepreneurial spirit, and really started to focus on what was best for me and my family. And starting my own company was the decision I made. And Brady Capital launched in August of 2021, and we've been pounding pavement ever since, coming up on our 3-year anniversary. So it's been a hell of a ride. I definitely credit a lot of the mentors, as I mentioned, that I had along the way, that kind of taught me the right way to do business, or hopefully the right way to do business. But yeah, I think in a nutshell, that's kind of the walk of life, and brings you up to speed.
Yeah, no, absolutely. And it's a hell of an overview. And I think what's interesting is that you've had, from my perspective, right, you've had exposure to the different components of the deal process, right, or the capital raise process, or the actual investing life cycle, right, whether it's raising equity, whether it's originating more agency type loan products. Now it seems, obviously, and this is my knowledge as being a client of yours, kind of carved out a focus as it relates to sourcing debt from local banks, local credit unions, more regional lenders versus agency lenders, which I don't think there are as many individuals doing what you do, or as many firms doing what you do, as, for example, just originating agency debt. I think there's a lot of mortgage brokers out there that do that. And I think at least a lot of the folks listening to this podcast that are in multifamily, and when they think of debt brokers, mortgage brokers, I think they initially think of folks originating, Fannie Mae loans, Freddie Mac loans, debt from similar sources, and that's more of a commoditized business, at least in my opinion, as it relates to the folks that play in that space. So with that being said, I guess I just teased it, but can you describe your business as it relates to where you guys fit into the debt market, where you kind of specialize, whether that's deals from a geographic standpoint, whether it's the type of lenders you typically work with, type of borrowers, all that fun stuff?
Sure. So I think, generally speaking, we're New England based, and 95% of our volume is New England. We're hyper focused in multifamily. We do a little bit of industrial, a little bit of retail, mixed use, office, to the extent that there's a story that can resonate with lenders, whether it's low leverage or suburban or whatever it might be. And the deal space, it's middle market, right? It's like that 2 to 50 million range. I having been at an agency shop for as long as I was, I mean, there are times when the agencies are really competitive. The process changes as the years go, and it definitely gets more challenging with the change in requirements that they might have, whether it's paper cuts or more granular underwriting specifics that are needed. But generally speaking, and I say this often, and I talk about this with clients and friendly competitors and brokers and attorneys. We're just so well banked in New England. We're almost spoiled in that sense, where if you parachute into another market in the country, be it the Southeast, the Midwest, there might be a handful of banks that are active, but most folks are borrowing agency in those markets. Up here, most folks are borrowing from banks, and we are spoiled. I think the relationships that I've developed over the years, and developed with my past employer, and have only deepened those relationships since we got started. Is it helps us be well positioned, right? We're always going to be the shop that goes the extra mile when it comes to underwriting, presentation, level of detail. How can we make the lives of a loan officer that much easier when they need to take, whether it's a deal to pre-screen to issue a term sheet, or let's say we're in underwriting, how can we basically make this a hands-free process, not only for the client side, and I'm not even talking about pitching the client side right now, it's really the lender side, because the lenders are our clients too. And I think it's that, the level of care that we provide to the lending side of the table, and how much we put transparency and honesty and being detail oriented above all else, because unfortunately there are some bad apples in the business that create the stigma around commercial mortgage brokers. And to the folks listening that weren't familiar, there were issues with another shop that basically put all brokers on pre-review with the agencies during the last year, and that was challenging. We didn't really face those headwinds because we haven't done a lot of agency over the last almost 2 years now. And I think that's partly the market, right? I'd say 80% of our deal volume these days is acquisition value add. And all of these value add deals have, a reasonable amount of construction, right? If we're going to go in and reposition these assets, breathe life into old and tired product that is in desperate need of repair and upgrade, et cetera, right? Your business plan. You can't do that with agency financing. I mean, you can, but then you're going to be overfunding your equity piece, right?
Yep.
So you got to bring more cash in, more LPs, for example, and that's going to compress your returns. Not to mention, this is assuming you don't want to pay up and spread for some sort of step down prepay. A lot of the agency loans are going to have that yield maintenance, and in a rate environment like this, taking yield maintenance could be misguided, right? You might be satisfied offering these returns, locking in a super low leverage Fannie deal, tier 4, tight spread. You might get 115 over the 10-year treasury and get full term IO, and you can manufacture returns for your investors. But coming up with 45% down is a lot of money to put down. And if the returns work and you're satisfied, your investors are satisfied, I see that there is a world that exists where taking agency right now might make sense. But a lot of these deals, especially in New England, where the real estate is just, it's old. It's a lot of legacy assets. I can't tell you how many deals year to date, our average year built might be like 1972. So tell me
Mhm.
something that's 50 years old that doesn't need, I don't know, 15,000 a unit, 25,000 a unit, sometimes even more than that. Once you get up under the hood and see what's going on with the electric and plumbing and heating and whatnot. So, I guess all that to say, we're just so well banked up here, and the banks, whether it's banks, credit unions, community banks, regional banks, you name it, they understand the value add thesis. And so long as, we check boxes, mostly relative to cash flow, which we can get into that, right?
Yeah.
But we're very lucky to be in the market we are, and there are still a bunch of banks out there that are actively lending right now. The market has changed a lot, but yeah, we're very fortunate to be in the market we're in.
It's so interesting because I have a lot of folks on the podcast that operate outside of New England, right? Whether they're doing deals in the Midwest or the Southwest or the Southeast. Over the last few years, I think the vast majority of multifamily related news has been as it relates to the high growth markets, whether those are the big Texas cities, Florida, Georgia, heading down into the Carolinas. And that's really been that's been the multifamily conversation for a number of years, really, especially since 2020. As throughout COVID, you get all the population influx in those markets. And as you just mentioned, the vast majority of those deals are done with agency debt because the terms are so much more competitive than the local banks. And we saw this because we did a number of deals in Florida.
That's
So we,
right.
granted, we're much more active in New England than we are in Florida, but we did 4 deals down in Florida. And trying to explain the value add thesis and explain how we can take the rents from the eights and the 900s up to 14, 15, 1600s. And it's like this because he's owned it for 25 years and, et cetera, et cetera, et cetera. All the stuff that we're both familiar with and most of the folks listening are familiar with. It's a much harder conversation to have. And I think that's the source of or one of the reasons why obviously there's more distress on average in those types of markets, because you have a lot of the value add buyers that fix their rate because they're going with a Fannie product, or excuse me, they elected to use a floating rate because they're going with a Fannie or a Freddie product. They know they want to refi or sell in a year or two, but the prepayment penalties or the yield maintenance is so disadvantageous for a business plan like that if you fix your rate that you're forced into a floating rate product. Where in New England, you can kind of have your cake and eat it too, for that reason, where we can fix the rate for 5 years. We can maybe negotiate a little bit more of a flexible prepay structure. So we have flexibility a year, a couple years in, whether we're selling or refinancing. Obviously, it comes with personal guarantees and all of that, but it's a little bit easier to get deals done with a local lender. So I'm constantly having this conversation too with LPs who are thinking about investing in our deals, but they have a history of investing in deals in Florida or Texas or what Phoenix, the Arizona, whatever market, right? Tucson or Phoenix, and they just don't really understand that dynamic, and it's almost like a re-education process. It's really hard to compare what happens in New England to what's happening in other parts of the country where there's just been significantly less distress, right? And so that's going to be the first current events question that I ask you, because we're going to get into what's going on nowadays, and I think that's going to be where we really sink our teeth into conversationally.
Sure.
Are you seeing distress? Like, what is the behind the scenes as it relates to distress, and we can assign it to New England? I know what the answer is, but but for everyone listening, like, what is actually going on behind the scenes in terms of borrowers who took down deals at 21, right, height of the market? And obviously, different states in New England are going to have slightly different dynamics. I think we can speak broadly, and it's going to be a safe kind of broad assumption there. But what are you seeing
Sure.
behind the scenes?
A great question, and I've answered it a couple times, over the last, when did the headlines start? Maybe, 12 to
Yeah, mid
18 months
22 or
ago.
whenever rates started to
Here it
head up.
comes. Here it comes. We've been waiting for this. People licking their chops. That's not to say that I cannot see distress on the horizon, but every loan that I placed in 2020 and 2021 was like 10-year fixed money in the low to mid threes. Uh, I'll have people call, and it'll be a prospect or an introduction, or even someone call cold, and oh, Pat, I saw your name in the New England Real Estate Journal. I see you're active. What I'm really trying to do is either get in front of some banks that are looking to offload some bad loans, or I'm looking to get in front of some of the clients before they give the keys back. And I might just be fortunate, but there's no balloon risk, right?
Yeah.
There's no floating rate risk. I know it's prevalent elsewhere in the country, and you see some of the headlines. I've seen them myself. I was just looking at another one in Atlanta, Georgia, where the floating rate started 2 years ago, and it might have been what 5% when they started. Now it's like 12%. I haven't closed a floating rate loan in my career, and I've been at this for quite a bit of time now. I think maybe I'm spoiled with the clients that I have, or maybe I get back to that the fact that we're spoiled by the banking environment that we're in. But I haven't seen any real distress. I haven't had a client call and say, "Hey, Pat, I'm looking for a referral to interview some brokers. I need to hire a broker and get this property listed. We need to sell. We're in some trouble, and our interest rate is out of control, and we can't keep serving." Like whatever it might be, it's not happening in my world. So I guess anecdotally, do I hear that there are some situations from time to time, whether I'm on the phone with colleagues in the business, or friends of friends, where, oh, I can't believe it that the guy didn't hit his rents, or he's actually thinking about pivoting and trying to do a condo sellout. It's more of the great exception. There's no
Yeah.
rule up here. That's not to say that there weren't folks out there fixing 5-year money in 2020 and 2021. Maybe overpaying for an asset, sure, overpaying for an asset. Some rents, can heal all deals, right? And rents definitely took off there. So it helps, but if they're staring down let's say a rate reset, they only took a 5-year loan and it was 20 or 21. The chickens aren't coming home to roost until sometime in 2025 or 2026. So we might start to see more of those, but generally speaking, when I'm having conversations with lenders, there aren't large delinquency issues. And
Mhm.
as you know, we're frequently in contact with, I don't know, anywhere from 50 to 100 banks throughout the region at any given time. I just, yeah, I haven't seen a lot of distress. And just to touch on, quickly, folks will call and say, "Oh, looking to buy REO. Tell me about REO opportunity. Tell me, a bank that wants to get a loan off their books." And it's like, all of these banks, that they're smart, right? Even if there is an opportunity where, all right, they've had to accelerate, foreclose, take the property back, they're probably hiring a broker to go market it for sale anyways. So,
Yeah.
that's not to say an occasional jump ball might happen, but I'm probably going to be the last guy to find out about it.
Yeah, exactly. Yeah, well, it's interesting, and I talk about it on the podcast a lot, right? Where you have a few different types of distress. You have the ownership distress of a couple partners, have a fallout and they go out there and sell the building, or somebody inherits a building from a family member that passed, or
Estate,
they want to
yeah.
go retire, right? That's unrelated to debt. Then you have operational distress, which is I hired the wrong management company or the wrong GC, and I spent too much to renovate, and they're not leasing my units correctly, and I misunderwrote the deal, what have you. And then you have debt distress, which is like, I got a balloon coming, or I use the wrong debt product. I use a floating rate product. And sure, I bought it right, and I have no ownership level distress, and we're operating it well. But like my rate went from 5 to 12, as you mentioned in your example. Obviously, that's going to create some element of stress. But we don't really have the last two in New England. So and I think that's the other important thing to note as well, as it relates to where we're playing, right? And our sandbox is the operational distress component, where you have significantly more operational distress in a market like Phoenix, where they are building a ton of new products, and which is healthy for the local real estate market if you're a tenant, right? But it's a little bit more challenging if you're an investor trying to underwrite rents where rents hockey sticked up and then they started really falling off a cliff and they're going down double-digit percentages and all kinds of concessions and the same thing in Austin, Texas, a lot of markets throughout the country where that happened. Whereas we don't really have that in New England either. We didn't build to meet housing demand. So I obviously operate in New Hampshire. You lend a lot in New Hampshire, or broker debt, I should say, in New Hampshire. I live in Boston, so I see both. You're active in both. It's like I'm a tenant in Boston. I'm going out there and renting apartments personally, and rents are not coming down. And neither is that happening in New Hampshire, where sure, rent may be slowing as a percentage year over year increase comparatively to like 20 and 21 and 22, but we're not it's not flatlining or falling, right? And there's still significant housing demand in a shortfall of supply. So we're not getting the debt distress, we're not getting the operational distress. So therefore, where is the distress coming from? It's those one-off situations where somebody's getting divorced and they got to sell off their portfolio, or random situations like that. But they can go out there and take it to the market and still probably sell it for a healthy price. So it's a bit of a different dynamic, long and short.
Right. I think just one more aside. Yeah, that there might be balloon risk over the next 2 to 3 years if rates remain elevated, and I think that's just going to require whether it's clients that syndicate equity to go out and do a capital call and say, look, that the market hasn't played in our favor. We need to retire our existing debt, and we need to bring a bunch of equity to the closing table to do it. We still believe in our basis. We still believe in the thesis. Yields are definitely going to get compressed. But you talk about themes and conversations you have, and I've heard from a couple banks over the last month, call it, where 2024 and their 24, 25, and 26 is going to be the right side of the loan years, and that makes sense, right? Because rates have pretty much doubled, and your cash flow can't support the debt load that you would have otherwise taken out in 20 and 21 and the start of 22. So it's definitely going to be interesting to see what happens.
For sure. Now, because you're behind the scenes in a lot of transactions, whether we're talking refinances, whether we're talking buys, I'm sure you have level of familiarity with sales too, just anecdotally with clients that might be selling and letting hey, we're selling, etc. How have you seen cap rates move? And this is a vague question, so I'll try and define it a little bit more. But obviously, cap rates in Boston are different than they are in Manchester, New Hampshire, and that's different than Providence, Rhode Island. So New England is a broad market, but I'll let you kind of define how you're going to speak about this. But in general, over the last couple of years, as rates have started to increase, talk about how you've seen maybe cap rates increase as it relates to what banks are typically comfortable with underwriting as like an exit cap or in-place cap rate, maybe what you're seeing appraisers use. How are you seeing movement there in terms of values?
Sure. I'd say generally speaking, as it relates to refi appraisals, cap rates are up, and you're dealing with less transaction volume, so the need to find current comps is it's a challenge, right? There's just not a lot of trade activity, but I say that kind of tongue in cheek because there are still deals actively closing in the market where folks are buying stuff mid 4 to high 4 caps. Not all cap rates are created equal, right?
And also, what type of product? I'm going to ask you probably a couple times to assign, like, built in the last 30 years, BA class type stuff, or
sure, you could call it B and C class. You could call it built in the last 60 years. But if the rents are so low going in, right? They're just so low. The cap rate going in almost doesn't matter. I follow a strip mall guy on LinkedIn.
As do I. It's a great follow.
I mean, he had a great post about it the other day, pretty much kind of saying the same thing. It's like the going in cap rate. If you're a buyer and you only buy on, I need to be going in, above a 6 to make this deal work. It's like, all right, did you even study the deal? Do you know what the rent potential is? Do you know where you can stabilize at? The conversation I have with a lot of the people I would consider the smarter folks, it's all about return on cost, and I know you touch on it quite a bit in your posts on social media and in your podcast, and it's all about where can you stabilize. And I think the prudent investor isn't counting on rent growth. It's where can I stabilize with today's rents? What do I know I can rent these units for? And, what's the path to get me there? Like, we know there isn't much cash flow going in. I'm going to have to size probably a larger down payment. I might even need to size for an interest reserve, right? If I'm not even break even on the cash flow going in. But if I can pencil I don't know, call it a 8% stabilized return on cost in a 6.75 to 7 interest rate environment, and maybe get lucky with rates during the hold period, but still be able to throw off, mid to high single digit cash on cash, get a little bit of positive leverage. Stories like that still resonate with folks. I think everyone wants to stabilize at a 10 cap, right? 10% stabilized return on cost sounds terrific right now, but I think generally speaking, cap rates are up, values are down, and there's still such a large gap in that bid ask gap, right? Where I don't know how much longer rates need to stay where they are for sellers to start to, not necessarily understand that the market has changed, but that the metrics have changed. A lot of buyers are just pencils down right now. And I mean, who knows that they could be the smart ones versus the folks that, are still actively trying to pursue and buying deals well below replacement cost, and that whole this too shall pass mindset where if you liked it 10 years ago at this number, you definitely like it today at this number. And if you can manufacture some returns and live to see another day, whether it's with 5, 7, or 10-year fixed rate debt, I just, we all might look back 5 years from now and be like, crap, we should have bought everything, right?
Yeah.
We also might look back and be like, I can't believe I even bought that deal. I should have just waited for the market to bottom out. But at time in the market, that seems like a game that doesn't work out for anyone.
Yeah, and I would imagine, obviously this is an incredibly nuanced conversation that we're simplifying, right? I think everybody listening probably understands that, and there's all kinds of variables, right? It's like if you're doing deals in a more densely populated area, higher median incomes, more recently built, that's probably trades in the mid fives. I don't, whatever, right? Let's just to find a cap rate. Within 30 minutes of core Boston, for example, that's going to be a bit of a different thought process than doing a deal in slightly more rural New Hampshire, where the market cap might be in the sevens, right? In terms of an appraiser going up there and appraising it. And if you stabilize that into the 10 range, which are possible, right? We're finding deals like that, but they're not in those densely populated markets. They're a little bit more tertiary. You're at least creating a spread between rate and cap, right? And I think that there's a little bit of or I should say rate in your stabilized yield on cost is what I'm trying to say. That's a bit of a different risk profile than playing that a little bit more tight as it relates to the spread you're achieving. So what is the right answer? It's hard for any of us to say. We're obviously just trying to make the best decisions we have with the information that we have in the moment. But I think you hit on it, which is the lack of trades makes it hard to really understand where that market actually is. I
think I'd share just, as an example, I closed a transaction in February where, when the deal had got brought out to market, it was priced, $6 million higher than where the client of mine had closed on it. And, the ultimate quote unquote sale price, right, was basically 15% less than where the anticipated initial strike price was. And that was because rates had moved against us. It was still a high 4 cap going in, and there's still a ton of value to be created. Granted, it needs several $1 million worth of construction to kind of cure a bunch of deferred maintenance and breathe life into the units that are just tired, right? But I think if you get on the phone with it depends who you're speaking to. There might be a colleague of mine that can't make anything pencil at less than a 7 cap right now. And the next guy is looking, or the next guy to call me on is say, I'm going to take a run at this thing. It's a 5.5 going in, but I think I can stabilize close to a 9. This is a good deal. It's in my backyard. I'm going to dollar cost average because I own so much in the area. And there's a lot of compelling reasons for folks to be doing deals right now, and a lot of compelling reasons for folks not to be doing deals right now. So I don't you know I hear all different types of investment thesis throughout the week and throughout the month, throughout the year, whatever it might be, and I can usually get talked into whoever's on the phone, or what competitive advantage that they might have for that deal.
Yeah, and this is where we get into the nuance of everybody's individual objectives, right? If you're a sponsor and you got to do deals to put food on the table, like you're obviously completely you're approaching the business in a completely different way than an individual who's got a day job or runs a business that's like, I'll invest in real estate when I have some extra cash. Like those are two completely different buyers.
Right.
One's going to be doing deals every segment, or, at every point in the market. One of them can afford to sit around and be a little bit more patient. Um,
That's right.
so it's interesting, right? And me falling a little bit more closer to the sponsor side of the spectrum, where like we're in the business of doing deals and we have infrastructure built to go out there and find great deals. The lever that we play with as it relates to, hey, we're feeling a little uncomfortable with maybe where the market's going or with the risk profile associated with a certain deal is let's just stabilize to a higher number. So, we want to stabilize to a 9.5 in a 7 cap market versus a couple of years ago, we were okay stabilizing to an 8.5 because, the market was a 6 cap market, right? We can just call it Manchester, New Hampshire. I think everybody who's listening is aware that we invest there, and that's kind of the cap rate environment in that marketplace right now. So
3 years
to
ago,
pull
we were
different
talking
levels.
about stabilizing at a 6.5.
Yeah. I was never that. I never felt that comfortable. Although I could have done deals with those numbers, and now we're going
Probably
back
been
to. I look
okay.
back
Yeah.
at every single deal we were direct to seller on in 2020. Banging my head against the wall we didn't buy, but everyone's saying that, so it's not just me. But nevertheless, there are ways to participate and still feel comfortable. I think, right, versus just completely exiting from the equation. I think you just, obviously it's just a function of finding and doing better deals. But speaking of that, let's talk about the challenges in getting deals financed, because obviously that is more challenging regardless if we're working with agencies, you're working with local banks, credit unions, buying stabilized, buying value add, doesn't matter. It's harder to get deals financed. So a general question for you, obviously within the context of who you're typically taking deals to, which are the local banks and credit unions or the regional banks and credit unions. And I think discussing this in the context of how it's changed over the last couple of years will probably be helpful as well as it relates to maybe people that are outside of this market, what you're sharing as it relates to what's current. They may not have something to benchmark that against. But let's just talk about, really what you're placing, which is a lot of B and C class kind of debt for value add business plans based on what you've defined as the primary focus for BCA. How has that changed over the last few months, 6 months, 9 months? I'll let you kind of run with it.
Sure. I think the clearest change has just been, what's the cash flow going in? That's the conversation we're having frequently with folks. We used to be able to size to like let's say a 0.8 debt cover going in on an amortizing basis, and be able to finance, that might have been 75% of the purchase price at that point in time. Pair it with a little bit of an interest reserve to get north of break even, or maybe even get all the way up to 125 with an interest reserve. Those days are gone pretty much. Aside from a bright spot here and there, or a lender who's super comfortable with a sponsor who's executed on a business plan on a number of different occasions. You got to be at break even going in. And some folks, some banks are anything less than 120 going in, their hands are tied. And I think it's partly the regulators, right, that are staying close to the banks right now, and I think it's prudent, right? We don't know where rates are going to go from here, so while the free money party was on, and that there were rates that we could at least count on for a long period of time, being able to size to a reasonable debt service coverage ratio going in is just a conversation I'm having frequently. And not all those are created equal. We're just getting feedback on a deal we're in the market with down in Connecticut right now, and some folks are throwing out 675 for 5. Some folks are throwing out 8.25 for 5. Right? There's such a spread between where banks are pricing deals, and you have different conversations, right? Some banks are saying, look, we booked a bunch of 12-month CDs at 5.5%. So that's our cost of funds. That's how we're looking at it. We're offering 5.5. We want a net interest margin of at least 200, if not 250. So there you are. You're right at 7.5 to 8%. There are some community banks in the market that might be a little bit more flush in deposits than others, or you might have an instance where a bank, whoever the bank might be, gets paid off on a large construction loan that they had on the street, and they want to turn around and redeploy that capital. So they might offer a rate special. You might see something in the high sixes. We had a bank actually email us earlier in the week that said they were allocating funds for rates in the range of 6.25 to 6.5, and it's for Massachusetts deals only. Sorry, Axel.
Damn
But
it.
there's such a disparity between cost of funds, and not all banks have the same deposits on hand, and then deposits become a significant discussion. We have some banks that they'll quote a deal and the terms and structure will be somewhat competitive, and then you scroll down a little bit on the term sheet and you see deposits, and it says will require, whether it's 10% of the loan, or as we've seen, as much as 30% of the loan, to basically crystallize the terms that they're offering, right? And it's like, all right, so I want to borrow 10 million bucks, but you need me to give you 3 million plus the other 3 million I needed to come with for the down payment. So now I got to come up with 6 million just to get this loan. And I don't necessarily blame the banks for wanting to bring more deposits on hand. It's just it's such a unique time. It is such a unique
Mhm.
time out here, and I just I don't know where we go from here, but remain to be thankful that there are folks that are still active, and aside from a few pain points, whether it's prepays, right? Prepays are touchy right now because I think banks are thinking the way that we are, or protecting against the downside is probably a better way to describe it, right? Rates could go down from here, and we're going to put all this money to work at such and such rate or cost of funds, whichever you want to refer to it as. If you're the lender, you're calling it cost of funds, but and yeah, rates might go down. So we're going to agree to waive prepays and basically build them in a rate reset. It's like that's been a touch point alongside deposits as well. And yeah, I think it's just it seems to be something new every day.
Oh yeah, no, I mean that's for sure. I think both of our daily realities, us on the buy side or on the refi side, trying to. I mean, what I've noticed is the most significant change is what you mentioned as it relates to deposit requirements. Like that wasn't something I remember being a component of a term sheet that was ever really in contention from 2020 to probably like early 23, maybe 12 months ago. And I think over the last year, that's become a much more significant talking point.
For sure.
Minimum deposit balances that you fall below that, and now you're in violation of your loan covenants, right? And there's recourse. Which is just fundamentally equity, right? So it's like, all right, we can play with the LTV or we can increase the LTV, but then have this minimum deposit. It's like it's all fundamentally equity brought to closing. So it's all basically it's just a different way to skin a cat, I think, for a bank. But obviously there's a regulatory component as well as it relates to banks too, obviously having deposits on file and being able to lend. Um, so this begs the question, outside of deal specific challenges, obviously debt service coverage issues, and that affecting LTVs and all of that. And this is a little bit more of a general question for all of the listeners too, as it relates to just working with banks or credit unions or mortgage brokers, whether you're in New England or outside of New England. What can borrowers do? I mean, I guess what do you in your conversations with banks, what are they looking for from borrowers, maybe outside of deal specific metrics that excite them, that they kind of need to see? Another way of asking that is, I guess, is if you're a borrower, how do you present well? How do how do you best engage with a mortgage broker or a bank when you're taking a deal out? So maybe there's some data points that we could discuss there, or just in general, how do what are some tips you have for borrowers out there trying to get deals done that want to present well
Sure.
above and beyond the deal they're bringing?
I think with a lot of the lenders that we work with, the track record kind of speaks for itself. So maybe the answer is better catered to the folks that don't necessarily have the track record, and not not that it's a plug or anything, but find a good co-GP, right?
Yeah.
Someone that has an established track record that does present well, whether it's the management in-house or just the long-standing track record of executing on this business plan, such that, being the guy doing the first time deal, I might even argue that he is better served trying to find the community bank down the street and go in there, shake their hands, saying, look, here's my business plan. I've put together my business plan, and here's what I'm going to do, and here's how I'm going to come up with the money. And if you make me, I'll retain professional third party management. I know that this deal is going to succeed. But aside from that, it's really, how can we talk about it all the time. How can we button up the best looking story before we go out to market? And, to the extent that borrowers have a back office and have an in-house property management team and have an in-house construction management team and basically handle everything 360 degrees of their real estate operation, that presents well. And, not for nothing, money talks, BS walks, right? Strong balance sheets and very strong liquidity positions, that it does do a lot at the end of the day from a credit risk standpoint. But, the banks that we're talking to, character is important. The things that you see, uh, I, I just, I can't advise enough that if you're not quite ready to start doing your own deals and you don't want to just be chasing your tail, right? Calling around, Googling for banks and calling 30 or so banks. Save yourself the trouble. Just give me a call and let me give you some guidance. And I might tell you, yeah, I know an operator in this market. You might want to call him, or I can introduce you. Bring him in as a co-GP and structure some deal where you're going to get compensated for finding the deal and perhaps some sweat equity as well, but also get the experience and start building up your own track record.
100%. Yeah, I'm always saying that too. It's, the first, not even just the first deal, but the first handful of deals aren't supposed to be the ones that, that make you rich, so to speak, right? It's you're getting in the game, you're getting the reps, you're building the track record, building the story, building the resume so that you can go and do the next one on your own. Because it doesn't
And
make
even
sense to
that,
delay that time. Yeah.
and even that first time operator that goes down the street to the community bank, I mean, deals are tough to get done right now. So even if they like the guy, they like his approach, they're going to get the deposit relationship. There's going to be all these compelling reasons to do that deal. That loan officer still has to go present to loan committee and tell the story of why they should take a risk on this first time guy right now. And you could spend 45 days and thousands of dollars just to find out that, look, we like you a lot. We want you to get some more experience. You come back to us when you're ready. And it's like, it's just, it's difficult right now. In a market where nothing's easy, lenders are looking for what's easy. The deal quality is challenging. Cash flows are challenging. Credit is tightening to a certain extent. But I think that they're always going to be better served bringing in, someone like you, Axel, or, someone like the number of other folks that I know we know together.
The it pains me even sharing this story. Since you know the market, you'll appreciate it. A friend and I back in 2018, when I was, whatever, I was 3-4 deals in, small deals. We contacted the seller of a 40-unit property in Rochester, New Hampshire. I'm changing the numbers slightly here, so there's no like confidentiality or anything like that. But it was around 40 units. We had under 1970s build. Had it under contract at 65,000 a unit, which now that's a 200,000 per unit property on a peak piece of land where there's more that could be developed. And we didn't want to waive the financing contingency because we weren't sure that we could get a deal done, but we were extremely confident in it and et cetera, et cetera. Seller ended up going with a guy who, again, had all the time in the world, 90, 120 days to close, but just waived the contingency. And we look back, me and the buddy of mine who we look back, we laugh about it, right? Because that would have been a game-changing deal for us, financially, business growth, all that. And it was like we just were too hesitant to go bring it to the person that could take it across the finish line, no brainer, and give them a slice of the equity. Don't have your own version of that story. Long story short, if you're listening, it's a painful one, so don't do that.
My heart breaks for you.
Yeah, it all worked out. Of course, everything works out, and it's all for a reason. But there's, I think, a lot of people that are hesitant to do that early on. They look back and they regret not doing that. Just if you give a slice of your deal to somebody that gets it across the finish line, the momentum that comes from that outside of the financial implications is also extremely impactful, and that's harder to quantify, but it's really important. Last thing here before because we're coming up on time. What separates guys like yourself, the elite brokers that do a lot of business, that conduct, that have great relationships in the marketplace, from maybe the average folks? If people are in New England, they should just go give you a call. But let's say that we got a guy listening who's in one of the other markets that we mentioned, Southeast, Southwest, et cetera. They know that they want to, they've been working directly with banks. They want to go build a relationship with somebody like yourself. How should they think about finding a great debt broker to work with, and how can they actually spot the good ones?
Sure. I'm flattered that you would consider me elite, but all joking aside, I mean, we put in as much effort as we can, and we mentioned it on our website, and it's not lip service, right? For every deal that we close, we probably underwrite 10 that don't. And it's nice for clients that don't necessarily have the back office set up just yet, right? We're kind of like a transactional based director of finance, right? So to the fact that other listeners in other markets are trying to find the right mortgage broker to work with, I'd err towards the ones that are showing you some effort, and you can put them under a CA or an NDA if you're superstitious about information going elsewhere, right? Hey, we're looking at this deal, we're looking to get some feedback. We'll always underwrite a deal and put together, like a debt model as to how we feel the debt might size going in, where we can get the cash flow to stabilize, and how much that plug allows us to play with from a construction standpoint, and go back with reasonable guidance. And we'll probably aim high on the rate. We'll probably aim short on the leverage just to get you the model comfortably, and hope that when we do clear the market, we come back with a better rate or more leverage or a few surprises, right? A guy a long time ago, early in my career, said, if you do nothing else in this business, it's manage expectations, and it's always under promise and over deliver. And that advice has served me well throughout my career. And I think to the extent that you're working with a guy that's showing you a ton of effort, to call him when you finally do get one under contract. Obviously, he's probably going to work like hell to make sure that gets financed for you, and you probably want to ask around too, right? Like wherever the market you might be in, I'm sure you're networked. You might know an appraiser, you might know a real estate closing attorney, you might know a real estate broker. If it's a mortgage broker that's active and has a track record of closing deals, other contemporaries or other industry professionals are going to know that they exist. So do your homework. That would be my advice. I think aside from the effort, right, whether it's modeling deals that don't necessarily go anywhere, or handling some communications on their behalf, or helping them, correspond with banks, or, what's the best way to put together construction draws. There's got to be a level of knowledge that kind of is just, hey, here's a rate and here's a loan amount. It's got to be a little bit more about the relationship as a whole. Like, tell me about this bank that you brought me, and what is their construction draw process going to be like? Are we going to be using a third party engineer that's going to review, every piece of paper that comes and goes between us, a GC if applicable, or subs or whatever it might be? Just tell me what I'm in for before I sign this thing. What do the loan documents look like, right? It's great to get a term sheet, and even more wonderful to get a commitment letter. But I've had deals, kind of hit pause in the loan doc stage with some stuff that just, for whatever reason, it may have provided a significant amount of heartburn either to the client or the client's counsel. So it's just, you kind of know what the hot points are with the lenders that you deal with. And, to the extent that you're looking at a deal or interviewing a mortgage broker, and you want to understand, the type of lenders he works with and the type of process that they can expect. Forget about the front end, forget about closing, but after we close, the amount of knowledge there, you'll be able to tell, right, whether or not they've been doing it for a long time and have the relationships and know how these things play because they've seen them play out.
Mm-hmm. No, all great tips. I mean, that's all fantastic, right? And I think I've worked with a fair share of whether it's real estate brokers or debt brokers or other folks that live in the transactional side of the real estate business, where they're just connectors. They're not helpful beyond just the connecting, right? Like, the best debt brokers, the best real estate brokers are the people that are riding shotgun throughout the entire transaction. A lot of people just connect the parties that need to be connected, and then they recede into the abyss, and they're not adding value along the way.
Keep me posted. Let me know when you need my invoice.
Yeah, exactly. It's like, I appreciate the help on the front end, but it's nice to have somebody also going to bat for you throughout, the 60-day process or however long it takes to close. I mean, because there's a lot that happens between those two periods of time, whether it's putting a deal under contract or signing a term sheet and then actually closing a loan or closing a deal. So all great tips there. I mean, this has been a great episode. I think people are going to take a lot away from this, Pat. Where can folks reach out to you? Where can they learn more about you and your business?
Sure. I'd send them to my website, www.bradycapitaladvisors.com. I'm sure you can, throw the link up when you post or whatnot. But, if you want to read up, if you like what we have to say, and you're looking at a deal or just looking to have general conversation, I'd say reach out. I'll never shy away from a phone call, and it's more that pay it forward mentality, right? I was so fortunate enough to have the mentors that I've had in the business. So even if you're just getting into the game and looking for a quick 30-minute conversation over the phone or on Teams or Zoom or whatever it might be, I'm always open to be a resource to folks, because you never know. I think you definitely subscribe to the put good vibes out into the world, and it usually comes back to you in spades.
Absolutely. Well, that's the real estate game, right? That's the relationship business that we happen to be in. So, if you're a listener out there in New England and you're doing deals, and you reach out to Pat, let him know that I sent you, right? So I get some street cred out of this. But obviously, I highly recommend everybody that's actually doing deals and is transacting and is either looking for debt, whether that's buying, refining, or if you're on the sales side and you want somebody's take on maybe how a buyer might look at it, or that buyer's lender, certainly give them a call or shoot them an email. So all that will be in the show notes. So feel free to go there to get that link. And Pat, thanks again for your time, man. This was great.
No, thank you for having me, and it feels good to finally be on my first podcast. I hope I did okay, and I really appreciate it, Axel. So thanks for all you do for our business already, and looking forward to hopefully corresponding with a few more folks in the future.